We're talking about the global economic landscape and, of course, the QE2 with two leading economic thinkers on the global stage today. Joining us right now is Dr. Robert Johnson. He's Executive Director for the Institute of New Economic Thinking and a Senior Fellow and Director of Global Finance at Roosevelt Institute. As well, joining us is Joseph Stiglitz, of course, former member of the Council of Economic Advisors under President Clinton and a leading global educator on the global stage. Gentlemen, good to have you on the program. Thanks very much for joining us. So you heard what Bill Gross said just a moment ago. Your thoughts on that? I want to get into quantitative easing, the impact there, and how you see the economic recovery at this point.
Well, I think the United States is struggling. There's a lot of idle resources, and the idea that they should put a tourniquet on a worn-out infrastructure is quite misguided. We have to restore hope and faith and confidence in productivity. Yes, there may be grounds for reorienting government spending towards productive investment and away from consumption. But this seems to be, as he said, kind of killing flies with a bazooka.
Joe?
I agree. The real problem is the way we're spending money, not the amount we're spending. And right now, if we cut back our support, the economy is going to get weaker, tax revenues will get lower. What we really need to do is actually increase our spending on investments in infrastructure, technology, education, and cut back our spending, for instance, on weapons that don't work against enemies that don't exist, wars that we're going to lose in any case. So let's focus on strengthening our economy.
I saw a quote from Timothy Geithner here yesterday saying Keynesianism is dead.
Geithner said that?
Yeah.
Anybody says that doesn't understand economics.
Well, but maybe he's trying to reassure us on the state of the U.S., to say, look, is that a way of saying we are going to get to dealing with the deficits?
Yeah, but Keynesian economics does not say you don't deal with a deficit. What it says is when there's excess capacity, and anybody looking at the United States says there's excess capacity, 1 out of 6 Americans who would like a full-time job can't get one. Those are times in which you have to stimulate the economy. And what matters is the quality of spending. Over the long run, you have to have fiscal order.
Okay, so where is the plan, though? Where's the it's fine in the short term, but where's the long-term plan to reassure investors about debt?
Well, the long-term plan comes from productivity growth, from a more educated population, stronger infrastructure, as Joe's talking about, investment spending. The short-term stuff, the Keynesian stuff you're talking about, Tim Geithner's probably ready to disavow that because he's going into a debt ceiling negotiation. But if he can work toward that medium term, which is not really Keynesian, I think we can all be better off. And these idle resources that Joe mentioned are people that aren't paying taxes that could be, and that closes the deficit.
Well, that's a great point. Let me ask you about the reaction to where we are in the economy. Of course, the markets have been quite vibrant, and I wonder if that has everything to do with QE2 and the Federal Reserve, and what happens when the Fed buying of security stops, and we're expecting that to, of course, happen in April. And Joe, you mentioned recently Europe and the Eurozone and the sustainability of the euro. I want to get to that as well. But talk to us about QE2. Does the market turn around and start trading down once the Fed leaves?
Well, we used to have the Greenspan put. Now we got Bernanke's buoyancy.
Yeah.
He's underneath us and pumping it up. Yeah. And when he takes the air needle out of the balloon, I think we will see some leakage.
And you think that's April?
Well, I think that's probably the right time.
But they may go through QE3. The point is they made it clear that there's ambiguity. Let's be clear. QE2 is not helping the American economy very much. What we need is the fiscal stimulus, and it was all a diversion from what we really need. We got a little stimulus, by the way, in the payroll tax cut. Not the best way of spending money, but a little stimulus. But that ends at the end of this year. So even if we get through April, there's another problem coming in December.
Why?
Well, the payroll tax cut stops.
Right.
That means people's income, disposable income goes down, spending goes down. And if you thought that in December the economy was ready to take off again, you could say, okay, we've sort of used this as a transition. That was the mistake they made 2 years ago where they thought it was going to be a 2-year recession.
What about the euro? You think it's in jeopardy?
Jeopardy is not the right word. I think that there's going to be a lot of instability in Europe. Markets often like the idea of a strong euro. The fact is that a weak euro is good for German exports and those parts of Europe that can export. It's bad for the United States.
Although a strong euro helps Germany German exporters buying raw commodities. So I mean, it works on both sides of it.
But net,
yeah,
a weaker currency is good for the real side of the economy.
Perhaps the most important thing here is that the rest of the world, China, Japan, want a vibrant, successful euro. Is that perhaps the most important point to make?
First of all, they want an alternative to the dollar because of all the sloppiness we've been talking about in U.S. fiscal policy. Secondly, they'd like to see Europe put it together and build a common, what you might call political structure. They have common monetary policy, they need common fiscal structure, and they need to stop bailing out banks and have the sovereign restructuring, some haircuts and write-downs. People who take risk have to pay the price when they lose.
So you think the euro is the alternative then?
I think the euro can be.
Yeah.
Well, I think we need a global reserve system because what we're going to see is the kind of instability going from the euro to the dollar to the euro. You need another, in the 21st century, trying to go back to a single multiple currency is not going to work.
Gentlemen, thank you very much. Great insights from leading thinkers on the global stage. We appreciate it, gentlemen. Thank you very much.
That's why we come to Davos,
Absolutely,
right? That's why we're here.